Hello everybody, welcome to this week's edition of Northwest Quadrant Wealth Management e-News. Thanks for joining us. So obviously a lot has transpired since the so-called Liberation Day on April 2nd. We have seen unprecedented market volatility both to the downside and the upside, which we understand that makes lots of you very uncomfortable. And in reality, the thing that's making most people uncomfortable is the uncertainty around what has gone on. And we're not here to say that we have clarity on certainty with what's going on in Washington, D.C., but we are starting to see maybe a little bit more clarity in behavior of what we ultimately think is going to happen. So markets are ultra volatile because of the uncertainty. Markets hate uncertainty more than anything else. But to put this in perspective, essentially the market is where it was a year ago. And a lot of you, I think, a year ago certainly weren't worried about markets and how they were doing. So volatility is the price you pay for the higher returns that are delivered by stocks over time. And the volatility we're seeing right now, well, in the short term, it's relatively extreme. It's not unprecedented. In almost every single year, going back to 1928, we get a 10% or more correction. So this isn't unusual. Maybe what's causing it is making you all crazy like it is us. But needless to say, this isn't unusual and is to be expected, especially when you look at how high stock prices were at the end of last year. A correction was certainly necessary, and we never know what the catalyst is when we're going to get a correction. But ultimately, as we move forward and hopefully get more certainty, markets can trade off that certainty. But again, markets, to put this in perspective, markets are where they were a year ago, and none of you were worried about them then. And we think the only option for all of you is to stay invested. We cannot time this. Go back throughout your investing career. We've had a lot of very scary times, but all of them ended, and this one too as well.
We spend our days engrossed in the daily machinations of this stuff playing out, and we take that for granted. But 7 years ago, of course, we had 2018, where we had a previous iteration of this trade war stuff, and then and now it's all really only about the great power competition between the United States and China. This initially was an order of magnitude greater than that kicked off trade war in 2018, but the playbook is starting to very closely resemble what we saw 7 years ago, which as these tariffs were initially envisioned, at least there was going to be catastrophic consequences for global trade. Necessity has sort of played its hand now. All of these exceptions are being rolled out, and there obviously seems to be a version of a put under markets in terms of the administration not willing to see financial markets collapse. As much as we hate to admit it, and it's an existential dilemma, I think, for all Americans, ultimately the market is the economy now. And that that's sad to acknowledge, and while there's a large percentage of the population that's not exposed, market valuations are ultimately now what drives spending, because 10% of our population is half of consumer spending, and we're an economy where roughly 3/4 of economic output is services and consumer spending. So that's really all that matters at the end of the day. And now that all of the exceptions are being rolled out, we see this ultimately probably playing out very similarly to 2018. We had a near 20% correction in stocks in 2018. The market finished down 6%. But we're going to trot out the succession of world leaders, sign a bunch of deals that incrementally probably aren't going to change much, and the great power competition between the United States and China is going to continue down that path of inevitable conflict, or however it may be resolved. But we are getting closer to an inflection point in that relationship. But as it relates to markets, at least in the near term, everything can change at one fell swoop. So it's really tough for us to sort of have a near-term prediction, but at least over the longer, medium run, it's looking like 2018 redux.
Yeah, and I would urge a lot of you, I know it's very difficult, but try to take politics and your political bent out of the equation when you're thinking about this. I know it's difficult, but if you do that and you look out to the future, remember, stock prices are a proxy for earnings, and earnings out in the future are going to grow, and stock prices will follow that. I would say that relative to the comment Josh just made about the short term, the data we're getting right now out of the economy is stale and not relevant. Earnings season has started, but that's backward looking, so none of that data is going to matter. The data that's going to start to matter on the U.S. economy is the data we start to get in May and then the next earnings season. That's what everybody is looking towards as it relates to, are we going to go into a recession or not? And I guess only time will tell, but our point to you is you have to stay invested. You know, the bonds in your portfolio are doing exactly what they're supposed to do. You know, people were bummed about owning them over the last 5 years because they didn't really do anything, but now they're certainly living up to what they're supposed to be doing in your portfolio. So as always, if you have questions about your account or your situation, give us a call at the office, 800-743-0988, or you can email either one of us, Josh or Tyler, at northwestquadrantwealth.com. We'll see you back here in a couple weeks.